Your money-making broadcast starts now. Markets closed slightly higher on Thursday, May 21st, capping a quiet session ahead of NVIDIA's earnings after the bell. The S&P 500 edged up 0.2% to $742.72, the Nasdaq 100 gained 0.19% to $714.51, and the Dow Jones Industrial Average rose 0.57% to $503.11. On the TSX, it was a mixed picture. While we don't have the full index data today, Canadian Pacific Kansas City, CP.TO, surged over 6% for the week, making it one of the most notable movers in the Canadian market. Energy stocks like Enbridge and financial heavyweights like Royal Bank of Canada also saw continued interest as investors positioned for a shifting macroeconomic environment. The day's core tension came from conflicting signals out of Washington. Hawkish Fed commentary fought against renewed trade optimism, and a surprise move from Warren Buffett into airline stocks shook up the transportation sector. Let's break it all down, with a Canadian lens on everything that matters to your portfolio. Let's start with the Federal. On Thursday, markets were wrestling with increasingly hawkish signals from the Federal Reserve. Several voting members delivered speeches suggesting that rate cuts may be pushed further into the second half of the year, with inflation proving stickier than anticipated. The core PCE reading, due out next week, is now the single most important data point on every trader's radar. Behind the scenes, the internal conflict at the Fed is growing louder. Kevin Warsh, a key advisor to the administration on monetary policy, has reportedly been at odds with Chair Powell over the pace of easing. Warsh favors a more cautious approach, arguing that premature cuts could reignite inflation. That puts him directly in conflict with market expectations, which are still pricing in at least one rate cut by September. For Canadian investors, this matters because a hawkish Fed keeps the US dollar strong, which puts pressure on the Canadian dollar. A weaker loonie is a double-edged sword. It helps Canadian exporters like Enbridge and Canadian Pacific, but it also makes imported goods more expensive and can weigh on consumer discretionary stocks. The Bank of Canada will be watching the Fed's next move closely, as any divergence in rate policy between the two countries could widen the US-Canada interest rate spread even further. Story 2 is all about geopolitics and trade. President Trump and Chinese President Xi Jinping are expected to meet within the next 2 weeks for a high-stakes summit aimed at de-escalating the ongoing trade war. Markets rallied on the news, and for Canadian investors, this is a particularly significant development. Canada is one of the world's largest exporters of canola and potash, two commodities that have been caught in the crossfire of US-China trade tensions. If a deal materializes, Chinese demand for Canadian agricultural products could rebound sharply. Potash producers like Nutrien stand to benefit directly. Similarly, Canadian canola farmers have been locked out of the Chinese market for years due to political friction. A broader trade thaw between Washington and Beijing could create the diplomatic space for Ottawa to renegotiate access. The energy sector is also watching closely. A stronger Chinese economy means higher demand for oil, which benefits Canadian producers and pipeline companies like Enbridge and TC Energy. The summit is still weeks away, but the market is already pricing in a more constructive outcome. The third story is the one everyone's talking about. Berkshire Hathaway disclosed a $2.6 billion stake in Delta Air Lines, sending airline stocks soaring. Delta jumped over 5% on the news, and the broader airline sector followed suit. This is a massive vote of confidence from the Oracle of Omaha, in an industry he once swore off after selling his entire airline portfolio during COVID. So why now? Buffett sees value in a sector that has been beaten down by fuel costs, labor disputes, and travel demand uncertainty. Delta, in particular, has strong cost discipline and a premium brand that commands pricing power. For Canadian viewers, the Berkshire Delta buy has a direct ripple effect. Air Canada is the country's largest carrier and competes directly with Delta on transborder routes. Any tailwind that lifts the North American airline industry benefits Air Canada as well. Moreover, Bombardier, now focused solely on business jets, is a key supplier in the aviation supply chain. If Buffett is betting on air travel demand staying strong, that's a positive signal for the entire aerospace ecosystem. Canadian Pacific Railway, CP.TO, also benefits indirectly. More air travel means more goods movement through integrated rail-to-air logistics networks. Story 4 is the elephant in the room, NVDA earnings after the close. NVDA has been the most important stock in the market all year, and Thursday's after-hours report was the defining event of the week. While the specific numbers were still coming in as we recorded this, the expectations were sky-high. NVIDIA has become the bellwether for the entire AI trade, and its guidance effectively sets the tone for the semiconductor sector for the next quarter. For Canadian tech investors, NVIDIA's performance has direct implications. While Canada doesn't have a direct NVIDIA equivalent, the TSX has meaningful exposure to the semiconductor and AI ecosystem through companies like ATRL, the SNC-Lavalin subsidiary that provides AI-driven engineering services, and Lightspeed Commerce, which uses AI-powered analytics for its point-of-sale systems. Shopify, Canada's largest tech company, also benefits from a strong AI narrative as it integrates machine learning into its e-commerce platform. If NVDA delivers a beat and raises guidance, it could lift the entire Canadian tech sector. If it disappoints, expect a rotation out of growth names and into defensive sectors like utilities and healthcare on the TSX. Story 5 is the biggest winner of the day, Cisco Systems, CSCO, which surged 3.37% to close at $118.20. The network giant reported strong quarterly results driven by AI networking demand. Cisco is emerging as a key beneficiary of the AI infrastructure build-out, as hyperscale data centers need more routers, switches, and security hardware to handle the massive data flows generated by large language models and AI inference workloads. CEO Chuck Robbins explicitly called out AI as a multi-year tailwind during the earnings call. For Canadian investors, CSCO's rally highlights an important theme. Canada's tech ecosystem, while smaller than Silicon Valley's, is heavy on enterprise software and networking. Companies like CGI Incorporated and Descartes Systems Group operate in adjacent spaces. Canadian pension funds are also among the largest institutional holders of Cisco shares. A sustained rally in AI networking stocks creates positive spillover effects for the entire Canadian technology investment landscape. Now let's talk stock picks. These are 4 investments with a Canadian emphasis, ranging from defensive to high growth. First up is the safe pick. Pfizer, PFE at $25.95, is a defensive pharmaceutical giant trading near book value. Benjamin Graham, the father of value investing, would approve of Pfizer's margin of safety. The company has a strong pipeline beyond COVID products, including its Prevnar vaccine franchise and new oncology treatments. Pfizer's dividend yield of over 5% makes it a reliable income generator in an uncertain rate environment. For Canadian retirees and income-focused portfolios, Pfizer is a solid defensive anchor. Second is the balanced pick. Cisco Systems, CSCO, at $118.20, fits Peter Lynch's philosophy of investing in what you understand. Lynch famously said to buy businesses you can explain in 3 minutes. Cisco makes the routers and switches that power the internet, a business anyone can understand. With AI networking as a new growth catalyst and a reasonable valuation, Cisco is a textbook Lynch-style stalwart with growth characteristics. Canadian tech investors who missed the NVDA rally can get AI exposure through a more established name. Third is the growth pick. Micron Technology, MU at $762.10, was up 4.11% on Thursday. Phil Fisher, the growth investing pioneer, believed in buying companies with strong R&D and a long runway. Micron fits that mold as a cyclical semiconductor company benefiting from the memory chip supercycle driven by AI data center demand. High bandwidth memory is essential for NVIDIA's AI GPUs, and Micron is one of only 3 suppliers in the world. For Canadian growth investors looking for semiconductor exposure without direct NVIDIA concentration risk, MU offers a compelling alternative. Fourth and finally, the cheap pick. Ford Motor Company, F at $13.67, gained 3.4% on Thursday. John Templeton, the contrarian value investor, famously bought when others were selling. Ford fits that playbook, it's trading near multi-year lows, has a dividend yield above 5%, and is undergoing a painful but necessary electric vehicle transition. For Canadian retail investors looking for an affordable entry point into a blue-chip name, Ford at $13.67 is about as cheap as it gets. Templeton would say the time to buy is when pessimism is at its peak, and Ford certainly qualifies. So here's where we stand as May 21st comes to a close. The market is navigating a complex environment: hawkish Fed headwinds, trade deal optimism, a surprise Buffett airline bet, and NVIDIA earnings that could set the tone for the rest of the month. For Canadian investors, the key themes remain clear. Trade-sensitive commodities like potash and canola are poised for a rebound, Canadian Pacific is showing incredible strength, and the AI networking boom is creating ripples all the way up north through companies like CGI and Descartes. Keep an eye on the Fed's next moves, watch the Trump-Xi summit closely, and remember that even in uncertain times, there are always opportunities for disciplined investors who do their homework. I'm Chloe. See you at 7 a.m. Eastern for shorts. Don't forget to subscribe. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.